What a week in financial markets as the stock market makes all kinds of records and not in the way you want it to. And as this 10-year Treasury swings wildly and causes the Trump pivot on tariffs, all the while gold and miners move higher and energy slips into a recessionary slump. This is Quiver Financial's weekly market report where we discuss what we're watching in markets and the moves that we're making for our clients as markets evolve. Well, like I said in the intro, it was a crazy week on Wall Street as the stock market made all kinds of records and not in the way you want it to. As you can see, I'm coming to you remotely today as I'm on the road looking for some tasty waves, actually watching markets and looking for some surf to get our minds off of these things. It has been a very wild time. Today, I'm going to share with you what we call the bear market investors playbook. It's been a crazy few weeks, right? Because this week, the big topics have been tariffs spark market crash, then rise, then crash, all sparking recession and bear market fears. So, it was just 2 weeks ago that people were looking at the tariffs, thinking to themselves, okay, we're going to have stagflation. So utilities were performing well, energy was performing well, gold was going higher. You could see some things were still working in the market. And then, boom, on Liberation Day, you got liberated from a good portion of your finances or your wealth because on Liberation Day, the trap door opened and even the stagflation playbook took a hit, which we talked about in previous episodes, that if the narrative were to shift from stagflation to recession or bear market, everything will sell off. And that's essentially what's happened. Along the way, though, the interest rate market is the thing that is really grabbing attention this week. The stock market's one thing, right? Down and up in record days. I mean, one day up 12%, down 10, it's craziness. The interest rate market, I mean, this is swinging like a hedonist because it's gone from 3 point, call it, to call it under 4% to over 4.5 in 3 days. And this is what caused the tariff pivot, the Trump pivot on tariffs, is that something was breaking down in the bond market. And all the while as that's happening, gold miners, they move higher, gold making a new all-time high. Silver now, even silver sold off in the initial sell-off, but now as people are, rotating or looking for some kinds of opportunities, we're starting to see silver and silver miners kick back, but gold and gold miners have been the winner in this, and energy, because now the narrative has gone from stagflation to recession fears. You've seen oil and energy sell off. So today, I'm going to share with you the bear market playbook because this week's action sure does look, smell, and feel like a bear market, not just a correction. So that's been one of the big questions that we've been talking about. Let's go through a little history here because it has been a wild ride, even in reporting this on a weekly basis. So just in February, we were singing with the Stones. Remember, you can't always get what you want. So we're singing with the Stones one moment saying, hey, we look like we can see what's happening with stagflation. Then we answer our client's number one question at the end of February, beginning of March, which is, hey, is Trump messing with my portfolio? Then we transitioned and said, oh boy, why is this baby ready for bear market stagflation and Trump tariffs? This is where we started to give you a little bit of the playbook of, hey, how to hedge things, what to watch for. Then we went into the danger, Will Robinson, danger, where we talked about stagflation. We got really deep into the stagflation playbook, talked about how certain sectors were still performing fairly well. Also gave the warning that if this morphs into more of a bearish market, that even the stagflation playbook will struggle. And now here we are a week or two later, not very far along in time. but a very far time in points within the S&P 500, the Nasdaq, and such. So it is time for me to dust off the bear market playbook. So what I'm going to share with you is the stuff that I've learned since 1998. These are the things that I learned in the dot-com bust, the Great Recession, the pandemic. So in all of these market sell-offs, bear markets, whatever you want to call them, shitty times, okay? And all of those times, these four things I'm going to share with you made a huge difference. So I haven't gone through the bear market playbook in many, many years. We haven't needed to. So here it is. I'm going to dig right into it. So if you're curious, step one, right? The first play here in the bear market playbook is to realize that champions are made in the off season. Now, what does that mean, right? Champions are made in the off season. It means that the real winners in any sport are the guys that in the off season are still training. Now, in financial markets, that means that even when times are good, when you're in the midst of a bull market and everybody's euphoric, that's not the time to become complacent. Champions don't become complacent when times are good. They continue to realize that the herd is often wrong. So what we're going to talk about in that first play is how to use the herd to your advantage. And one of the things I really want to get across to you is that the charts, the reason we use charts in a lot of the weekly reports is the charts lead the news. People think they hear a news, normally you hear on the news, hey, Trump did XYZ and the market did this. Now, usually the market makes a move and then the media frames the narrative around that. And I can show you headline after headline where just last week I've seen headlines in Europe that were completely contradictory by just two different news outlets. One saying that Ukraine is winning the war, one saying they're losing. I mean, so you can't believe what you read in the news. So the charts are our guide. Well, they're going to go deeper into that. I'm going to show you within this S&P 500 how this first playbook or rule in the playbook we're able to use. Second is that you want to be like Brady in the pocket. This cool heads score points. You don't want to panic. No panic selling in these situations. However, in order to be good at the second play, you got to get the first play down. So we're going to go into deeper that. I'm going to walk you through this process. Third play in the playbook is focus on what you can control. When the market starts to sell off and you feel panicky, you feel like, oh my God. Discipline, patience. If you did the first play right, you did the second play right. If you're a disciplined investor, you're looking long term and you're patient, you should just be perfectly fine. A lot of times when your nerves get you, it's just good to sit back, take a nice deep breath, and refocus. So we're going to get deeper into the third play of I'll give you some tools basically of how to use in there. And then last playbook, the last of them in the bear market playbook is remember, you've got 4 downs. There's a reason for that. So you want to buy and sell in stages. Whenever you're buying, even in a bull market, you don't jump in all at once. And when you're selling in a bull or bear market, you don't sell all at once. You don't be so hubris to think that you know that you nailed it that day just right. That's just not the way it works in markets. Murphy's Law is what works in markets, which is if you buy on Tuesday, it's going to go down on Wednesday, right? So be ready to buy some more, right? So we're going to get into each one of these step by step. First one, champions are made in the off season. I remember reading the book that Lance Armstrong had, and they were interviewing one of his competitors, and they said, "Yeah, we hate Lance because even in the off season, he's riding faster and harder than anybody else." And later they had an interview with Lance and he says, yeah, because you know what? Championships are won. They are won in the off season. And it's very, very true. And so, what I'm going to share with you is something that we've put out for years. We have this thing called the Smart Guy's Guide to Investing. You can find it on the website. A lot of what I'm going to talk about here is in this, and this is centered around behavioral finance. And one of the big things in behavioral finance is this herding mentality. So essentially, what happens is, you got to remember, we're mammals, okay, and mammals herd. That's how they stay safe in nature. Dolphins herd together, So if you got furry, softer skin, you got to hang out with your buddies in order to protect yourself. Okay, so that's basically the bottom line. So the brain is designed to herd. We saw this in the pandemic. When you don't know what to do, you'll look at what other people are doing and do exactly what they're doing. Okay, so that's exactly how it's designed to work so we can survive in nature. When it comes to financial markets, when the herd gets too euphoric, then that's your sign. So this is where you hear about two people being contrarian. So the number one rule to the first playbook is that when times are good, so I'm going to show you here on this continuum here, that when times are good and people are euphoric, like right here where we're saying the thrill. So this would be the November, December, January, when you're watching CNBC and everything they talk about is positive, positive, positive. Nobody brings it. In fact, if anybody tried to bring up any bearish views in that time frame, nobody paid attention. They didn't even give them the time of day. So when you see that happening, that's when right here, you can see right here I put start to make a list. So when you see that markets are getting euphoric, and the perfect example is exactly what we just experienced the last few months. When things don't make sense, then you start to make a list of the items in your portfolio that you're willing to sell. And this is when you pretend you're watching the movie Heat, where they say, when you see the heat around the corner, you drop and you run. So this is where you start to prepare and you make a list of the things that you're not convicted to, right? Because in every portfolio, if you got diversification, you're going to have some smaller fragmented holdings or maybe some stuff that you're just starting to build a position on and you're not necessarily convicted to it, right? So you have that mentally prepared in your head. So when you see the heat, when the market volatility starts to come on and things start to get wooky and wacky, you don't have to hesitate in creating cash. Because the saving grace when you get to the bottom of this is going to be how much cash you have. Because fortunes are made in bear markets, and they're made by the people who have the dry powder, who have the money available to buy when nobody else wants to buy. So when you're here at euphoria, like we just were over the last couple months, you're at maximum risk. Then you go through a process that we just saw over the last 3 weeks where people have some anxiety. The market bounces back. They go, oh, it's okay. We're going to be fine. It's different this time. Market rolls over a little bit further. You get fear. And as you saw this week, we got fear, desperation, panic, and capitulation. Wham, bam, 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 bam. And it will happen again. In a bear market, this cycle will happen at least two more times from this, at least 3 times throughout the whole process. We've gone through it once. Now, the next time we go through this process is the most important time to be prepared for it. Because now what you're going to see is you'll see the market go through some kind of recovery bounce. It'll start to get everybody out of their depression. It'll start to move to a point to get people optimistic. And then it'll start to get to the point where people think it's over. And then we'll go through this continuum one more time. If this is a bear market, you will see this continuum at least one more time. And on that one, that's the important one to really take advantage of. All right. So if this is not a bear market, things are over. Right. But I'm telling you right now, this week really did behave like a bear market. So champions are made in the off season because they're prepared. And how they're prepared is they're watching the herd. They're watching everybody else. And you got to remember, a person can be very smart and discerning. He people, on the other hand, in groups, can be very stupid. This has been known forever. If you read To Kill a Mockingbird, you remember the scene where the father's on the porch and the mob is there? The whole thing's about herd mentality. So this is I'm not teaching anything that hasn't been around. I just might be reminding you of it, that it gets repeated in financial markets, because financial markets are not rational. They're very emotional. When people run them, people are emotional. So in order to really get that first playbook down, you got to be attentive. So you can't be complacent at any moment when you're managing money. Now, if you are a home gamer, if you're managing your own portfolio, be as complacent as you want, write it up or down. If stuff like that makes you nervous, then hire somebody like us. So at least do some kind of quarterly or half yearly review. That's the one way that you can. And in that review, it's not just about how have I performed. It should be about how I have performed. Also, how am I invested now? How does the future look for those? What's going in the bigger macro picture? So this is why in our process, we bring in those 5 asset classes like currencies and commodities and interest rates, because that's the process of being attentive. You also want to be strategic. So that first part of the playbook, in order to use the herd to your advantage, in order to be a champion in the off season, you've got to be willing to be strategic. And that means you got to focus on the cycles. You got to see what's going up and down. You got to first decide, are you in a bull or bear market? Easiest way to do that is just watch our videos. We're telling you, we're laying this out for you. Or if you don't, hire us. We'll do it for you. All right. So playbook number 1 is use the herd to the advantage. Realize that champions are made in the off season. This is how it's done. We showed you in January that markets were getting to a level since the '08 bottom, since the Great Recession. This is how you become attentive. You start to zoom out and you realize, wow, this market, when I zoom out, sure does look parabolic. And are times really that much better today than they were here 2 years ago and the market was much lower? So those are the types of processes you got to go through before the bear market happens. One of the big signs we showed you in January is that, hey, history has shown it. And this time they tried to fool everybody into saying, oh, no, the retail investors today are more informed and they're smarter. Hey, yeah, guess what? In January and February, we showed you that everybody was in this. All the small investors were chasing this. Everybody was greedy. This was the classic Warren Buffett, Sir John Templeton, when everybody else is fearful, you should be greedy. When everybody else is greedy, you should be fearful. It makes so much sense now on the backside of a decline. But in January, nobody wanted to hear this shit. So this is how you use these things. So now as we look at what's happened in the S&P 500, you had this trend line of support that the market was holding for years, and now it's broken. That support now becomes resistance. So if you're in the S&P 500, if you're ready to panic this week, last week, whatever, and if you believe we're in a bear market. Now, if you think that the rest of the next 3-4 years is great and this is a buying opportunity, there's a different strategy, right? And also, if you're 30 or 40 years old, you may want to just sit this and just ride it out, because if you don't have a buying plan, you shouldn't be selling either. However, if you're 65, you're 70, you're 75, if you're in the later part of your life, if you're mature and savvy, all right? So if you're in that realm and the next 2, 3, 4 years really matters, then what I'm going to talk about becomes much more useful and more appropriate, more age appropriate. So investing is just like managing kids. You got to have age appropriate behaviors. And so in bear markets, what's age appropriate for somebody who's 70 is different than 30. So that's all, just realize that. So if you're in your later years or need your money within 10 years or less, and this is a bear market, then what we should see happen is the market we talked about last week, we hope would grab some footing. And that's what's happening right now. We've been bouncing this week around as low as 4,800 to 5,200. We've been swinging all around here, which was this green dotted line. This was our first target. This was our target of, hey, if this is a more than a correction, this is a bear market, this would be the first target that we would hope to get some footing. All right. So if this market from this point forward, from April 11th through, let's say, April 20th, the next week or two, if the market can bounce, then what you need to watch for, if you were nervous or wishing you sold before, is you watch your holdings bounce back up, and this green line, what used to be support, now will become resistance. So that will be the next tell. That we already hit it once last week at 5,800, and the market pulled over. We showed that to you in real time last week and the week before. So now's the next attempt. So, and you may not get that high. It may only be 52, 53. So now that, 54. So now the bounce we have to watch, because if you were nervous on that bounce is where you start to look at your holdings and make adjustments. For us, we made adjustments right before the decline. So what we're doing as Quiver and Quiver clients is we already created some cash. We sold some of the things we weren't convicted to before the trap door opened. We also sold some of our gold because we were afraid to get a margin call. We kept some in case it moved higher, and it has. And so what we ended up doing is we created enough cash and hedge that right now it's best to sit on our hands as a Quiver client. However, if you feel like, if last week you felt like if you're self-managing your portfolio and you felt like you let this go down too far, then the next bounce is where you want to really start to pay attention to how you can make some adjustments. So really, before I go into the next play, right? So this, as you can see, is a process where there's an attentive process. We're paying attention to the larger scale by zooming out. What did the market look at like over 5 and 10 years? And then we were zooming in to the most recent time, the last year, to then kind of figure out, okay, where's our support? Where's our resistance? Where can we wiggle around here? The point is this. I don't expect any of you watching this, unless you're a professional or you really want to put in the time, I don't expect you guys to get all of this. But what I'm trying to show to you is that there are tools that can be used to mitigate and manage risk, but they require an attentive process. Okay? So if you don't have the time or energy or willingness to be attentive, then hopefully you're young, or hopefully you got enough money that you can just, be hopeful. Good luck. All right. So playbook number 2. All right. So the second playbook is be like Brady in the pocket. Cool heads score points, right? So if you look at football or some of the greatest quarterbacks, they sit there and they're patient. And then if that pocket is collapsing, they don't waste time. So there's this really unique balance between being patient. That comes with confidence. That happens in the off season. If you've done your training, it's a lot easier to be patient in the pocket. So like right now, for the Quiver clients, we're right now standing in the pocket, and we've got to be patient, because for us to score the next points, we've got to have a clear view and we got to have confidence, right? You can't do that under panicky situations. So cool heads score, because you're able to read the battlefield, and is the way to execute a pass into the end zone, or if that pocket is collapsing, do I run like Russell Wilson, baby, right? All right, so number 1 is don't panic. So how do you do playbook number 2 is don't panic. Well, how do you not panic? Well, playbook number 1 really helps you. If you did your work in the off season, you're probably not going to panic in the middle of the game. Again, read the field. When I say if you see the pocket collapsing and run, that means reduce risk. Essentially, that is what we did when we drew that trend line, that green trend line. And when that broke and we started reducing risk, that's reading the field. First, you had to determine where that trend line, where that support was, then make a move when it broke down. okay? And you have to act fast. When that breaks down, you got to move just like when the pocket collapses, because that cash you're going to create is what you're going to use later. So visually, this is what I mean. Okay, so at the end of March, we showed you this chart. So what I mean by this is reading the battlefield or reading the field means that week by week, we were watching this and we said, hey, right now this looks like three waves, but it could turn into five. If it does, it will bounce up to here and then fail. And that's exactly what happened. The fact that we were watching for it is reading the battlefield. Okay. So doesn't mean that just because you read the battlefield, you're going to score. Doesn't mean you're not going to get sacked occasionally. Sometimes you do have to give up a down to win the game, right? So, but nonetheless, by tracking this on a regular basis. So we talked about this last week, where if we've got a breakdown below 5,600, we would hope that it'd get into the 5,200 range. That's where we are. I'm going to share more with you over the next couple of weeks. If this market bounces, how to play it, whether you should be a buyer, a seller, whatever it may be, based on different time frames. Okay. So now let's move into the third part of the playbook, which is, well, actually, let's talk about this. Is one of the keys to being good at that second play is to have discipline, which is you got to stick to your macro strategy. The discipline. When you hear people on CNBC say, "Don't panic, sell, have your discipline, be a long-term investor," what they're really saying to you is, when you start off with investing, you should start off with your time frame in mind. If you're investing with a 10-year, 20-year, 30-year time frame, and these kinds of things happen in markets, stick to the discipline of that mindset, which is, if you've got that long time frame, this should be a godsend. If you liked Apple at 160, you should love it at 100, right? Wall Street is the only place that when it goes on sale, people run out of the building. Nordstrom does a half yearly sale. Everybody wants to get in there. Wall Street does a half yearly sale. Everybody wants to run out of the building like it's on fire. So discipline means first know your time frame. And if your time frame is 5, 10, 15, 20 years, you can make different decisions than if your time frame is 6 months, a year, 18 months. If your time frame is that short, you shouldn't be even in the stock market. Okay. So number 2 is you now start to sell the rips. So part of that second play in the playbook is if this is a bear market, the saying is you go from buying the dips to selling the rips. That's what I showed you in the chart. If we get another bounce back towards like 5,800 that develops over days or weeks, and the euphoria starts to come back, or people start to say, oh, it looks like it's over, that's your opportunity. That's what I mean by sell the rips, if that happens. On these bounces that happen in bear markets, because what you have to remember is in bear markets, you get some of the biggest rallies. Like if you looked at the data of the largest one-day rallies, almost all of them are in bear markets. That's how cruel the market is. I mean, God has a sense of humor. It's, the best one-day returns happen in the worst, 2 years of declines. So on bounces, what you look for is you look in your portfolio, and if you have laggards, market's up 10% and something's only up 2 or is still down, probably, if you're not convicted to it, if you don't have a really long-term thesis to that investment, if it's a small fragmented holding, whatever it may be, probably best just to get it out of there, because when markets bounce and things don't bounce with it, that's a really bad sign. It means that when markets sell off, that thing's probably going to crash. So this is one of those times that on bounces, if you see weakness, you shoot it first, ask question later, move on. You're on the frontier here. So use technical analysis. That's the charts. Realize the charts lead the news. In the next couple of weeks, I'm going to show you how to use things like relative strength indexes, MACD, all those types of things that we use in the business. And at the end of it all, once you've done most of your work, you got no choice but to smoke them if you got them, like we showed you last week, And sometimes you got to just spend the weekend having a drink. I mean, if you saw me on Monday, you would have never known I was a financial advisor after last weekend. Got a lot of surf and a lot of smoking and drinking in. And on Monday, if you told your friends I was your advisor or investment guys, they would have been like, well, no wonder you're driving that 78 Pinto. All right, so one of the big things that you want to make sure that you do when you're in bear markets and even in bull markets is you want to make sure that you buy and sell in stages or tranches. I've said this many times. You never be so hubris that you think you buy everything at the best price at one time. You want to scale those purchases from a smaller to larger size. And keep in mind that odd numbers work really well, threes and fives, because just mathematically, it works better for you. I won't bore you with all the reasons. Just trust me on this. So what I mean by scale small purchases, if you have $10,000 you want to put into an investment, put $1,000. You're going to want to put five. You're going to want to put 10. You're going to want to, no, first one, put 1,000. Murphy's Law is you buy Tuesday, it goes down Wednesday. So put 1,000 in, watch it, then put 2 or 3, and then put 3 or 4. And so as you, if it's moving higher or lower, whatever your stash is, do these in stages. And as you get into the third or fourth or fifth purchase, they can be a little bit larger than the first ones. All right. Same thing in selling is most people sell too soon. And you really want your winners to run. So in selling, same thing. You sell in stages. The first sales do smaller and then bigger as you get further along. If you've been watching what we've been doing in gold, it's a perfect example. Gold's probably in its last push higher before it gets sacrificed. And so now we have our last allocation. Most likely we'll try and sell it into this next leg of strength. And along the way, we've been able to claim profits and have a clear mind. All right, so be willing to lose a down to win the game. That means good investors know how to take a profit. Great investors know how to take a loss. Don't be shy of taking losses. Sometimes people are so prideful. Sometimes people just have to be right more than rich, and they won't get rid of their losers. The best investors out there get rid of their losers and they move on. If you look at the best football players, best quarterbacks, if they had a bad play, they don't lament on it. They don't rue on it. They don't sit there. They move on to the next play. They depend on their training. Everything they did in the offseason, the preseason, everything they've done in the season, they focus on, and that plays behind them, focus on the next one. No use in crying over spilt milk. All right, so let's wrap this up, and then I'm going to show you a couple charts of a few things that happened this week, and we'll call it a day. So, playbook number 1, and this is the most important out of all of them, is champions are made in the off season. You want to use the herd to your advantage. Charts lead the news. You want to be like Brady in the pocket, cool heads, score points. Playbook number 3, or play number 3 within the playbook. I keep getting that wrong. Focus on what you can control. Discipline and patience matters. And then the fourth play is just know you have 4 downs for a reason. Sometimes you got to cut your losses to move on to the next. So those are the bear market playbook. I'm going to share more of that as it evolves over the next few weeks. But before we wrap it up, I want to share with you something that's gone on in the 10-year Treasury. And if you remember the Twilight Zone, that's what this is from. Hey, man, you want to see something really scary? So we've talked about the 10-year Treasury for 2 years, staying between these zones, 3.5 to call it 4.5, really 5, but 4.5 is really key here. And if we can stay in this range, it's the Goldilocks range. We were looking great at the end of March. I showed you that 4.5% looks really important if you believe that rates and the Fed are going to go lower throughout the year. We wanted to see it break below 4. It sure did. If you really want to see something scary, now here we go. So we dropped quickly down to almost, I call it like 3.8. Okay, and then whammo. We moved right up to 4.5. This is what got Trump to pivot on the tariffs. 4.5. We called 4.5% weeks ago, and little do I know, on Wednesday of this week, I'm hearing about 4.5% across the board. That the reason Trump called Besant in and they did all these things is because the 10-year was at 4.5, and there's a lot of reasons for this that we're going to talk about in the future. This is the kiss of death for traditional diversified portfolios or modern portfolio. If you have a 60-40 mix, stocks declining and rates rising is a nightmare, because when rates rise, your bond, that 40% in bonds, loses too. You're doing a 60-40 for hedging, and it works against you. So this is very concerning for all of the Edward Jones people, the Fisher investment people, almost all of my colleagues I'm scared for. Because if you get above 4.5 and the stock market keeps going lower, there isn't many places to hide unless you do what we do, which is focus on the 5 asset classes, because at least within those you can find somewhere to hide. So I'm going to wrap it up with encouraging everybody to read our last newsletter, Market Minutes from the Boardroom. We go through the charts. We talk about what we're looking at. I'll have an update on that. We normally do it quarterly, but we'll do an update in May. So stay tuned with this. Until next week, I highly recommend you read our last newsletter. Watch the Smart Guy's Guide to Investing. It's on our website. So get into the models. There's 4 models, and we walk you through things like managing your risk, your timeline, talking about how to use the herd to your advantage. There's some great stuff in that. It's a whole video tutorial that we put together years ago. And coming next week, I have something coming out called the Discouragement Trap: How to Dodge the Spiral and Win. The reason I did this is I really think a lot of my colleagues in the industry are going to get very discouraged. And so I want to make sure that I share some of the knowledge that I got over the past markets, like I am with you guys, that are helping us avoid discouragement. And until next week, take care of yourself, but more importantly, take better care of others, because there's going to be some stress going on. Take care, folks. Bye-bye.